Are you aware of the prerequisites for Tesla's upcoming 3-for-1 stock split? Many have been waiting anxiously for the shareholders' meeting to approve the proposed 3-for-1 stock split in the coming days. Keep an eye out to see what you need to do in the interim. Ever since Tesla made headlines as a firm worth investing in, a lot of investors have shown interest in the stock. The premier electric vehicle firm has demonstrated exceptional performance in the first and second quarter earnings reports for 2022. Even in the face of multiple obstacles, you'll learn what has to be done today in order to avoid the Tesla stock split that will divide 3-for-1. As the market leader in the US for battery-powered electric vehicle sales, Tesla commands a market share of almost 70%. The company's flagship Model 3 is the most well-liked electric car in the United States. Tesla has expanded dramatically since going public in 2010 and has gained a reputation as a gold standard in the process. Even so, the market capitalization of the traditional automakers Toyota, Volkswagen, Daimler, General Motors, and Ford remains inferior to that of the dominant electric vehicle company. With time, Tesla has moved from making exclusive products for affluent customers to mass-producing EVs that are more affordable for everyone. Tesla announced its intention to split its shares in March, and the electric car manufacturer submitted the necessary documents to the Securities and Exchange Commission in June to proceed with a 3-for-1 split. But unless shareholders approve the firm at its annual shareholders meeting in a few days, nothing is final. A company that splits its stock gives its stockholders new shares at a predetermined ratio. After a stock split, existing shareholders will own more shares, but the price will drop in accordance with the stock split ratio. A stock split, however, has no effect on the total market value of all of the shares. 2-for-1 or 3-for-1 common stock split ratios provide shareholders additional shares in proportion to the amount of shares they currently possess. The unit price of the shares will drop by a factor of 2 or 3 after the split, depending on the situation. Stock splits are also known as one-time special stock distributions in business announcements. A company may choose, with the approval of its shareholders, to split its stock more than once. A company may split its stock if it thinks the price of its shares has risen to the point that the typical investor cannot afford them. The steps involved in a company's stock split can be a little unclear, but Tesla has previously carried out one. Tesla split its shares for the first time in August 2020, and it was a success. The share price of the company shot above $2,000 after it announced that it was going to split its shares 5-for-1, making it eligible to become a member of the $1 trillion club. Furthermore, it wasn't the first time the business has tried to open up its stock to smaller investors. The business proposed a 1-for-10 reverse stock split of Tesla in 2015, but the action sparked a significant public outcry, prompting the decision to scrap the proposal. However, given that the company's valuation has climbed dramatically since the first effort, smaller investors will have to pay less to obtain shares, making Tesla's decision to split its stock again more likely to be successful this time. However, it's impossible to predict how Tesla's stock will perform following this stock split, given that US inflation is at its highest point in over 40 years and interest rate hikes are creating a sea of uncertainty. To remember that a split of stocks does not increase the value of the stock or increase the amount in your account. Before August 2020, when Tesla split its stock 5-for-1, a share was worth approximately $2,250. The split caused the share price to plummet to roughly $450. You were granted 5 shares of Tesla, each valued at $450, as opposed to 1 share valued at $2,250. The whole share's aggregate value did not change. Assume that, at the time of the upcoming split, Tesla shares are trading for about $720 per share. Following the big day, each investor will have 3 shares worth around $240 in their account for each share they owned the day before. Success is shown by a rise in a company's stock price. While this is good news, it also means that investors will now have a harder time acquiring the extremely valuable shares. In order to decrease the price and make the stock more appealing to private investors, companies may decide to split their shares. When a stock starts to creep up and appear expensive, it is customary to divide your stock to make it look more enticing from a per-share pricing standpoint. This encourages others to buy shares. This year, a number of well-known corporations, including Amazon, Spotify, and Alphabet, have joined the trend of stock splits. A stock split's most evident benefit is that it lowers the price at which a company's shares are trading. It's less of a problem now because individual investors may easily purchase fractional shares, but splits provide more investors the chance to purchase entire shares of a company, which may make them feel better about the transaction. Will you purchase Tesla shares if the planned split is approved at the next shareholders meeting? Post your ideas in the space provided for comments below. What ought investors to do in the interim? Holding cash versus dollar cost averaging is a decision that most investors struggle with. Since most people are aware that a bear market typically lasts 12 months, the stock of Tesla is expected to continue declining over the next 6 months. Less risk takers will probably continue to hoard their money and wait to enter the market until they start to show indications of improving. On the other hand, people who have a long-term view, don't utilize much margin, and have cash on hand are more likely to stick with dollar cost averaging and reinvest their cash every few months. For this reason, even if the price of Tesla's stock drops to 400 in the ensuing 6 months, the price in 5 years is what matters to them. The crucial query now is, after the split, will the price of Tesla stock rise? Since the last split, Tesla's stock price has increased by approximately 63% to $720, due in part to the company's excellent operational success. If the 3-for-1 split happened right now, each share would cost even less at a new price of around $240. After the Tesla stock split in 2022 is over, the share price can continue to rise for a number of reasons. The first is a higher capacity for output. It is well knowledge that Tesla struggled to meet demand from customers for their cars as a result of production constraints. The company's amazing expansion has slowed down due to a shortage of manufacturing capacity. That might change if 2 brand new gigafactories are constructed. With these upgrades, Tesla will be able to produce 2 million cars annually instead of just 1 million as previously. Regrettably, the company and other automakers still have issues with the raw material and component supply chains, particularly with semiconductors. On the other hand, it is expected that the Tesla stock charts will exhibit a notable increase in value after it is addressed. Improved margins and effective production techniques are further factors. With the difficulty and cost of manufacturing cars, analysts said Tesla would never turn a profit, even a few of the best. The maximum gross profit margin that automakers like Ford Motor Company may achieve is 15%. However, Tesla has developed techniques for producing electric vehicles that surpass those of the competition, and the superior quality of the final product justifies premium pricing. With a 32.9% gross margin, Tesla is far more flexible when it comes to operating expenses, such as developing new products and cutting-edge software breakthroughs like autonomous driving, which can help the company stay one step ahead of its rivals. While stock splits excite a lot of investors, they are rarely a reliable sign of a company's future performance. If you focus on the essentials and make investments in reputable companies, stock splits will be frosting on the cake. Nothing truly changes, so a stock split shouldn't have an impact on the price of the shares fundamentally. According to Reuters, research from Bank of America indicates that businesses that split their stock do about 16% better than other businesses in the year that follows the split. Yet, there's a chance that this is only a coincidental relationship, and it might have anything to do with the expansion of the business and other variables. Splitting stocks typically indicates a company's growth and confidence. However, traders of stocks and options frequently take advantage of the split scenario to their advantage, which can lead to significant market volatility both before and after the split. It is important to note, however, that most analysts believe Tesla has a bright future ahead of it. It is unlikely to see the kind of growth the company has seen over the last 2 to 3 years, even if its growth trajectory does not change in an upward direction. Most businesses, especially those in the technology industry, fit this description. They grow quickly initially, but as more competitors enter the market, their growth slows down. However, slower growth is still growth, and analysts generally concur that Tesla is still in a strong position to develop in the long run, but there may be some hiccups along the road for investors. Visit Tesla stock, check out our other videos, and don't forget to hit the like and subscribe buttons if the company's past is any guide.